All right, today we're going to dive deep into one of the most fascinating and, let's be honest, debated stocks out there, AST SpaceMobile. Now, this is a classic high-risk, high-reward situation for sure. So our goal here is to give you a solid framework, a way to think about this company like a serious investor. Let's get right into it.
So let me ask you a question. What if you never had to worry about a dead zone again? Ever? I mean, what if your normal, everyday phone, the one you're probably holding right now, could get a perfect signal in the middle of the ocean, or on top of a mountain, or in a super remote village? Well, that is the giant, ambitious vision that AST SpaceMobile is built on.
Okay, so here's how we're going to break this all down, kind of like an investor's checklist. First, we'll look at the core mission. What are they even trying to do? Then we'll talk about their moat, how they plan to defend their turf. After that, we'll check out the management and their recent momentum, dive into the financials, the good and the bad, tackle that big, tricky question of valuation, and then we'll wrap it all up with the big trade-off that every single investor has to weigh.
All right, first up, the mission. So what is this company actually building? Well, at its heart, it's all about creating a broadband network from space. And the goal is massive, to solve a huge global problem by connecting the billions of people who are still offline today.
Now here's the magic trick, the thing that really sets them apart. This is not about you having to buy some bulky, expensive satellite phone. Nope. The whole system is designed to connect directly to the standard smartphone that's already in your pocket. Think about that. No new hardware, no special apps to download. It's basically just a giant cell tower in space, extending the network you already use.
And just look at this number. This really shows you how huge the opportunity is. We're not talking about some small niche market here. The company's going after the, get this, roughly 3 billion people on Earth who don't have mobile broadband. Let that sink in for a second. From an investor's point of view, that is what you call a massive total addressable market.
Okay, but here's the thing. A market that big is going to attract a ton of competition, right? So the really critical question becomes, how is AST SpaceMobile going to protect itself? What's its competitive moat? Let's dig into the barriers they're trying to build.
So their whole defense strategy really comes down to 3 main pillars. First up is a huge technological barrier. We're talking about their own proprietary antenna tech, which is, by the way, the largest ever put on a commercial communication satellite. That's a big deal. Second, you've got a regulatory barrier. Getting permission to use cellular signals from space around the world, it's an incredibly complex nightmare of paperwork and approvals. Being the first one through that door is a massive advantage. And third, there's a powerful network effect. See, once the satellites are up there, the cost to add one more customer, it's basically zero. That's how you scale.
So what about the elephant in the room, Starlink? I know you're thinking it. Well, here's the really key difference. ASTS is designed to use the exact same cellular frequencies your phone already uses. It literally speaks directly to the chips already inside your phone. Other guys, like Starlink, are taking a different approach. And why does this matter? Because it makes it ridiculously easy for people to start using the service. The barrier to entry for a new user is practically non-existent.
Look, a great idea is one thing, but execution, that's the whole ballgame, especially when you're talking about something this expensive. So the real question is, can the team actually pull this off? Let's take a look at their recent progress and see how they're doing.
And this timeline right here shows they're making real, tangible progress. They had a successful test in orbit back in 2025, and they are not slowing down. The next satellite is already packed up and ready for a March launch. And the big prize they're aiming for? Having somewhere between 45 and 60 satellites up there by the end of 2026, which is when they can finally flip the switch on commercial service.
And yeah, they have the cash to make it happen. By the end of 2025, the company had over $3.9 billion in cash and credit available. That is a serious war chest, and it's all set aside to just hammer down on deploying these satellites and building out the business. So yeah, they are definitely well-funded enough to chase these aggressive goals.
Okay, now let's get real and talk about the money side of things. Because look, building a satellite network in space costs an absolute fortune. So this part is all about that classic tug of war you see with these kinds of companies, incredible growth potential on one side, and a massive, massive cash burn on the other.
So on the growth side, the numbers are actually pretty wild for a company that's basically just getting started. Check this out. Revenue leaped from just over $4 million in 2024 to almost $71 million in 2025. Now, that's mostly from selling ground equipment and hitting key government contract goals, but still, it's a really good sign that the gears of the business model are starting to turn.
But, and this is a big but, here's the flip side.
The company burned through almost $1.2 billion in 2025. That's the cold, hard reality of what it takes to build this thing. All that cash is going straight into making satellites, paying for rocket launches, building ground stations, the whole shebang. And you can expect that kind of spending to keep going right through 2026.
So the big question is, how does this fire hose of spending ever turn into a profitable business? Well, there are 3 key steps on that path. First, they need to shift from selling hardware one time to getting that sweet recurring service revenue. Second, that service revenue is designed to be super profitable, with margins north of 80%. And third, it's all about something called operating leverage. Basically, as more and more people sign up, the cost to run the whole network gets spread thinner and thinner, making each new user more profitable than the last.
Which, of course, brings us to the multi-billion-dollar question for any investor. What is AST SpaceMobile actually worth right now? You can't value this thing based on today's profits because there aren't any. It's all about what it could be in the future, and that makes it a really tough puzzle to solve.
Now, one of the standard ways analysts try to solve this is with something called a discounted cash flow model, or DCF. It's basically a way of guessing all the future cash a company will make and then calculating what that's worth today. So here are the key guesses from one model. They're assuming revenue hits $5 billion by 2030, that the company starts making more cash than it burns in 2028, and they're using a 12% discount rate, which is just a fancy way of saying we know there's a lot of risk here.
Okay, so you plug all those assumptions into the machine, and what does it spit out? This particular model calculates a fair value of around $61 a share. Now, considering the stock has been trading up around $96, that tells you something important. It suggests the current price already has a lot of optimism, a big premium baked right in. The market is expecting great things.
But you have to remember, a model like this is super sensitive to those initial guesses. For example, in a bull case, if everything goes perfectly, margins are great, the value could shoot up to somewhere between $100 and $150 a share. But on the other hand, in a bear case, if there are launch delays or people just don't sign up, that value could crash down below $40. It just goes to show you how wide the range of possible outcomes really is here.
So, fundamental value gives us one part of the picture. But for our last section, let's look at what the market itself seems to be thinking. We're going to use a different tool called technical analysis to try and get a feel for investor sentiment and understand the big trade-off everyone's facing right now.
And specifically, we're going to look at an analysis that uses something called Elliott wave theory. Now, it sounds super complicated, but the basic idea is pretty simple. It's a way of trying to read investor psychology, all that greed and fear, by finding repeating wave patterns in a stock's price chart. The whole point is to try and predict where the trend is going to go next.
So if you look at this weekly chart, one analyst thinks they've spotted a classic Elliott wave pattern. See that? It's what they call a 5-wave impulse move on the way up, and now they're predicting a 3-wave ABC correction. In plain English, the theory says a big, powerful move up has probably ended, and now a downward or corrective phase has started.
But, okay, how much faith should we put in this? Let's look at both sides. On the plus side, the pattern does look like a textbook impulse wave, and another indicator, the RSI, did a good job of signaling the top. But on the minus side, there's a potential issue where a key rule might have been broken. And remember that prediction of a drop to the $40 to $45 range? It's just that, a forecast. It is absolutely not a guarantee. It's just one person's interpretation of the market's mood.
And really, that brings us to the heart of the matter, the core dilemma. This quote from our source material just nails it. The stock's price today is already factoring in a good chunk of commercial success, but the actual satellites needed to achieve that success are still being built and launched. You see the problem? The market is pricing in the future, but the present is very much a construction site. So the ultimate question for you as an investor is this: how much risk are you willing to stomach for a shot at a vision that could, quite literally, change how we connect with the entire world?